So tonight we want to make sure you can get the first article of paper one out of the way, get it done. What's fresh in your mind this weekend, since you don't have anything else to do on this class at this point of the semester, is really this paper. So if we look at this rubric, the first article, we talked last class about their goal. You get that in the abstract and the conclusion if you go down to the conclusion. So be very explicit in your own words. Don't just copy their words. Don't just quote them, put it in your own words. But there's a few aspects to it. The abstract, they made some points that I don't think are true, but they say financial planners consider human capital, but I don't really think they do. But their goal in this relates specifically to asset allocation and what related to life insurance. Do you remember what specifically? Was it the type of life insurance? What were they looking for?
Short-term renewable life insurance.
Well, that's what they're using. Yeah. So they can use term, but what was their specific question related to life insurance? How much, the amount, right? So on the term, it wasn't, they weren't asking if 1 year term or 10 years is better. They used 1 year term because that's just what they use. But that wasn't the question. In fact, that's the more research is to see, hey, do other life insurance companies change the equation? So their specific answer on life insurance, make it really clear, because that's what, if that's what they say they're studying, you got to make it clear in your paper. What is your asset allocation? Should you be in stocks or bonds? That's the main thing they're asking. And then the second question is, how much life insurance should you have? It's not should you buy it or what type, it's the amount of life insurance. All right. And they think they use the word what? Unified model. Unified how? What's going to unify it? What's that one link that unifies those two decisions? Human capital, right? So really clear. How does human capital help you make those two decisions? You can see the easiest part of all is just take a picture and put it into the paper. Y'all know I use Snip. I didn't know how to use Snip, and then one of my classes said, "Why don't you just do Snip?" I was like, "Yeah." So y'all know how to do Snip. I use it all the time now. I was overtrained. So yeah, just bring that function in. Other than the D, I think it's very self-explanatory. But don't bring in the formula without the code. All right. So snip the whole thing. If you can take out the one if you want to. But that shows you what they're trying to accomplish. The life insurance is in the dead state, the QX. Your human capital is in the live state, 1 minus QX. We'll use QX later in the class because that's Q is your probability of dying. So 1 minus Q is your probability of living. So what you remember what U is? Sounds like really bad grammar. U is utility, happiness. So you alive and you dead. They're trying to maximize your alive happiness and your dead happiness. You remember what the W is? Wealth, right? So your paper is essentially going to be talking about each one of these things and a few other issues that they bring up at the end. And then the D is, I don't know, to me, it's how much you want to leave to your heirs or something. It's just hard to know. Is it a percentage or what? Obviously, since it's 1 minus and 1, it's some kind of percentage. But exactly how they do that, they say relative strength, but to me, it's just your desire to leave money to heirs. But I don't know how exactly. So you don't have to explain the formula so much as make sure you have it in your paper. I think it's pretty critical because it does bring it all together in here. So human capital and your wealth. So the asset allocation affects the W. Human capital is your human capital, and then the amount of life insurance. So they're trying to bring one unified model all together using human capital as the main link. And define human capital. So what are the components of human capital? So if you think about it, it's the present value of future earnings So that has two pieces, right? It has future earnings and it has a discount rate. You agree with that, right? Your future earnings and a discount rate. What affects future earnings? Your training, your career, how many years. I think they give a few other examples. The second article talks about optionality. Well, actually, I think optionality probably comes in more on the discount rate. So what affects the discount rate? Correlation, volatility, and this is where I think optionality. People with more optionality, they can change careers much more easily. They're going to have a lower discount rate because their human capitals can be less risky than someone who can't change jobs. What gets confusing in the paper is there's a big overlap between the definition of human capital. A lot of students struggle with what do we mean by magnitude? They really are essentially the same thing, but you need to read what they say about magnitude. Human capital is the basic equation of present value future earnings. Magnitude is where these concepts come in. So you do need to talk about magnitude. To me, magnitude is training, your career, and your discount rate, correlation, volatility, optionality. So you bring it in. It's a little bit of an overlap, no question. Now, how does it shift over time? That's where the timing comes in. Obviously, as you move through time, human capital shrinks because you just have fewer years to work. It's pretty straightforward. You can change it by getting more training, those type of things that will, anything would affect your earning potential. And a lot of students lose a lot of points on volatility and correlation. So the key with volatility and correlation is that discount rate. Make sure you have that really clear link. A more volatile job is more risky, so the higher discount rate, which means all else equal, lower human capital. So two people with the exact same pay, well, one is much more volatile. Maybe it's commission based. The other one's much more stable. Maybe they're a judge or a teacher. If they have the exact same income, the one with the more volatile is kind of a lower human capital. And in correlation, the main way to think about correlation is to think in terms of how it's correlated to the overall economy. Kind of somewhat what you learn with the capital asset pricing model. We're talking about systematic risk. So a job that you're gonna lose your job, you're gonna lose income when the economy's in a recession. That's gonna have a higher correlation and have a higher discount rate than a job that's not related to the economy. Okay. And make that link. It's amazing to me. It's such a critical. Why are they talking about volatility and correlation? It is all related to the discount rate. If you don't make that link, I do count off because it's so critical. You understand? That's the reason they're talking about it. Now, what's the link to life insurance and investing? So someone whose income is very volatile and highly correlated to the economy, what does that imply for their stock allocation? Higher or lower? Lower, right? If you're highly correlated to the economy and you have a really volatile income, you probably should invest more in bonds and less in stocks because your human capital looks more like a stock than like a bond. And same thing with correlation. So both of those, higher volatility, more correlation implies a higher discount rate, less human capital, more bond investing versus stock investing. Now, the life insurance link is pretty simple. If you have a more volatile job, so it reduces your human capital, what does that mean for life insurance? You need less life insurance because what is life insurance doing? It's hedging your human capital. So if your human capital is lower, your life insurance is lower. Okay. So let's try this. We got Bob. We got Mary. Stockbroker. Supreme Court judge. Have the exact same expected future income. What do you say about volatility and correlation? Just high or low for Bob? High. What about Mary?
Low.
Very low. And in correlation? High, low. Discount rate? High, low. Human capital? Lower, higher. Stock allocation? Lower, higher. Amount, life insurance, lower, higher. It's not an 8 and higher, but if you're not getting that from the article, go back and reread it. They-
Explain the bottom one, the life insurance, wouldn't it be higher?
Yeah, the amount of life insurance would be higher. Well, if human capital is higher, your amount of life insurance is higher. That's the link they're making. Life insurance replaces human capital. All right, so it's a direct link. Okay, does that make sense? They're making that argument. So if you're not seeing that in the article and you don't put it into your paper, you're definitely going to lose a lot of points there. You don't have to do a Bob and Mary, but you definitely could do that kind of example to prove to me you're really, really getting it. That's, on the critical thinking points, if you can give an example that's not in the article anywhere, that's a critical thinking type of points that can help you out. Right, so mortality risk, they say, only relates to life insurance. So people who think they're more likely to die are going to buy more life insurance than people who don't think that. That's a very straightforward one. One thing to make that link here is make sure you talk about life insurance as a -1 correlation to human capital. So life insurance is this perfect hedge to human capital. If you don't die, your human capital stays strong, but you get no life insurance. If you die, your human capital goes to 0, but you get all this life insurance. You can't get a more perfect hedge than that, especially if you're buying life insurance equal to your human capital. It's a perfect hedge. So I would put that -1 correlation in your paper. I can't remember if they say it like that. I think they do use the word hedge. Let's see. I don't know if I can do a search on this paper, though. I don't think this is a searchable paper.
They ended up saying something to the effect that there's like 100% correlation.
100%. Okay, so yeah. Yeah, it's in there somewhere. So yeah, make that strong. That's the argument that they're making. The beautiful thing about life insurance is it's about the only product out there that is that perfect hedge. Unemployment insurance is not. It only lasts for a certain amount of period. It doesn't completely cover you 100%, those kind of things. Life insurance covers it 1-for-1. Risk tolerance to me is, it's like a gimme points. This is the easy one unless you just forget to do it. But risk tolerance, if someone is very risk intolerant, how much are they going to buy in stocks? Someone who hates risk, what they do with their stock allocation? Buy less. Someone who's very hates risk, what are they going to do with life insurance? Buy more or buy less? Buy more. That one's obvious, isn't it? That's like the simplest one of all. People who have a very low risk tolerance, they just can't take risk, will put less in stocks and they'll buy more life insurance. That one should be a give me. Most people to get full credit on that one because it's pretty straightforward. Now, level of wealth, this one gets a little debating. Kind of depends on, you may have a different idea here. Often citation, the risk-free asset increases with wealth. So people with a lot of wealth buy less in stocks. Does that make sense? I don't always agree with that. I know some people that have enormous amounts of wealth and they're leaving their wealth to their children. And so they don't invest it for themselves, they're invested for their children. So if their children would do 80% in stocks, they put it 80% in stocks. But here they're talking about that wealth is being for you to cover you. And so they say, if you have a lot of wealth, the worst thing you do is put in a stock market and suddenly you don't have much wealth. So that's their argument. So more wealth, people tend to be more conservative in investment portfolio. Less wealth, you can roll the dice and go for it. What does more wealth do for life insurance? So we talked about Bill Gates. How much life insurance does Bill Gates need? Doesn't need any. So more wealth, why? And you can see it in the formula, can't you? So your ending portfolio is wealth plus life insurance. So the more wealth you have, the less life insurance you need. You essentially insure yourself. You got $1 billion. Or was it James Simons? We talked about him. Who's my earlier class? Riley, we talked about him. What, $29 billion is net worth? He probably doesn't have a lot of life insurance. He's 80 something years old, so he probably can't buy it anyway. But why would he go out and buy $1 million policy? It's like, no, it's just not worth it. So wealth, more wealth. The part that you might not agree with is more wealth means less in stocks, but obviously more wealth means less in life insurance. All right. You're essentially going through the cases and explaining the cases. Would probably not be a bad idea to put some of these graphs in there if you understand them and you think they explain it pretty well. The graphs can certainly help. Someone was asking me about sourcing. Anything you're pulling from the article, you don't have to give me the source. You don't have to give me a bibliography of this article. The only time you'd have to source if you pull something outside the article, which I'm not really asking for in this particular case. Now they say, and this is one I disagree with a little bit as well. They say the bequest motive only impacts life insurance. So that's what I was just saying earlier. So I have a friend here in town, he's worth tens of millions of dollars. He's leaving quite a bit of it to his children. That to me definitely impacts his stock allocation because he's got more than enough to take care of his needs. So I think the fact that he's leaving so much to his children and they're young, that actually I think does influence his stock allocation. But they essentially ignore that in his paper. So they say the bequest motive only impacts life insurance. I think that was a section on the bequest motive. I can't remember where it is. I think it's all in one section on, oh, here it is. So that one's pretty obvious, isn't it? Insurance demand increases as the bequest motive strengthens. If you want to leave more to your heirs if you die, obviously you're going to buy more life insurance. So that one's pretty obvious. So figure 4 shows almost no change in allocation for different strengths for the bequest motives. I question that. I kind of have to ask if that's really true. And you can question the article if you want to. If you disagree with them, just make sure you clearly state what they're saying. So you got to make their point, and I have no trouble saying, I don't agree with this or I question this, those kind of things. I mean, how would you invest if you had $80 million and you're 80 years old, 70 years old? or let's say you're 60 years old, so you have a 30-year-old child that you're going to leave that to, and the child's invested 90% stocks. Wouldn't you put that 90% stocks if that's being saved for them, or would you? But if you're not leaving it for your kid, maybe you're leaving it for your spouse, and your spouse is about your same, I think it makes a difference. Now, how did I figure this out in the case study? Because the case all depends on how the model's built and how it's set up. So, I don't know how they have that set up in there. So I question that. All right, questions up to there. Okay, let's look at the research, and I forget exactly where they put that in here. I wish I could search on this article. Here we go. Obviously, I'll make a distinction between the word obviously and the phrase of course. So they say obviously. Obviously to me means, well, duh. So they said obviously, is that duh? I guess that's true for anything you do. More research is needed, something that's complex. More research needs to be done. And then they give examples of where that research is. You got to get that into your paper. Don't just say more research is needed. Where is that research needed? They tell you that. So where is it needed? Various types of life insurance. We're going to talk term, level term, whole life, universal life, equity linked life. There's several versions we're going to talk about. There's only two I like out of that group. So we'll talk about why I don't like the other ones. I just saw a student who got a job at a life insurance company, and he's telling me what he's selling. I'm like, I told him to read my blog and see what he thinks. So various types of life insurance. Now, I actually see this as a separate thing. He ties it to the life insurance, but the tax side, I think, is pretty critical. So he is talking about the tax sheltering of the life insurance. Life insurance is an incredibly tax efficient vehicle. So you pay all this in, and when you die, you get it back, or your estate gets it back tax free. There's no tax on it if you set it up correctly. There are times where it can be taxable. That's why it can be really, really good for estate planning, because it's a very tax favored. If you think about it, someone, a person dies and their estate gets or their beneficiaries get $500,000 and there's no tax paid on that. That's a lot of money to be completely untaxed. So they're using annual term. What else could they use? So whole life and level term are probably the only two others they would do. Once you get outside of those two, especially universal life and equity linked, the modeling would become just almost insurmountable. So they're probably thinking those type. So they mentioned whole life. Now they mentioned variable. I don't think, I question that would be any value to doing variable life. We'll talk about why I hate variable life so much. Now here they make an interesting comment about the possible changes in systematic population mortality rates. So are they talking about people dying faster or dying more slowly? What are you more worried about if you're a life insurance company? People dying much faster. So how they would actually model that, I don't know, because life insurance has been fairly stable over time. There haven't been a lot of jumps. There's certainly been some changes with COVID and other things, but not a huge jumps. But it's an interesting concept. So not just life insurance being a hedge against human capital, but being a hedge against changes in mortality rates. Another direction to be to diverge from traditional utility models. I don't know how many of y'all read Kahneman and some of his stuff on behavioral finance. That's his whole deal, is to say humans don't actually make decisions and react the way these models say. They have a very different view of the world. I don't know how they figure out you alive and you dead. how they're exactly getting that. You remember in economics, y'all did utility functions. You know, you're trying to get the hit. Didn't it seem a little artificial when you did that? Like you're like, how would I actually think like that? And economists are trying to figure out how the human mind thinks, how it makes decisions, how it's satisfied. That's a really tough thing to put into a formula like this. So especially you did. But so they may look at other utility functions, such as minimizing short-term probabilities to determine the appropriate asset allocation decisions. So there's other things they want to research. Here in the paper, you can certainly add your own ideas of other things they should think about in a model like this. Does anyone see an obvious thing they left out? And then what's the last word you read in the article? Right there, right? You don't need to do the appendix. If you want to, you can, but you don't need to do the appendix. Did anybody try reading the appendix? Usually the appendix in these papers are them just showing off that, you know, they have the math skills. It's usually a lot of jargon. All right, let's look in the class notes because you also have that. So any questions on these 11 things? Look through it and see if there's anything. Was anything shocking in this article? All right, so in the class notes, I put some quotes that maybe help you a little bit. So they want to make asset allocation decisions and insurance decisions jointly, but be really clear exactly what life insurance decision you're making. They want to look at the magnitude of human capital. Remember, the magnitude is your income adjusted for the discount rate, its volatility and its correlation with other assets significantly affects the two decisions over the life cycle. In this article and in the second article, they think of human capital as being like an asset on your balance sheet. It has correlations, it has expected returns, it has volatility. So you're going to treat it just like any other asset. It's also an asset that can be hedged. So your stocks, you could hedge your stocks and buy options. You could hedge your bonds and buy credit default swaps. We don't normally do that, but for human capital, we do hedge that with life insurance. And then they have the objective function. So the factors you got to include: magnitude, volatility, correlation, subjective probability of death. We don't actually talk about that one in much. It's pretty obvious. Someone thinks they're going to die, they're going to buy more life insurance. Risk tolerance was an easy one. Your current wealth, the quest motive, and then the next article talks about optionality. And these will change over time, so you have to make a new assessment. It somewhat implies if you buy level term for 10 years, that it should decline every year because your human capital is falling. But most people aren't going to be quite that precise. So the case studies they do essentially go through each one of those factors, just make sure you understand each of them, and then consider whether or not you want to put one of the graphs into the paper. Let me see if there's anything else I have that's new. Yeah, be really, really clear. Yeah, on utility functions, you don't need this in your paper, but just to say, Kahneman makes a big point of this is most economists, they think of utility as a state. And what Kahneman has discovered is utility is usually a change in a state. It's not the actual state. And if economists are assuming our utility, our happiness is based on where we are and not how we got there, then he says you get very different answers. So a good example here is you got Bob and Sarah. I did Bob and Mary before, but they both start with $100,000. Bob, in the first year, he goes from $100,000 to $3 million. And in the second year, he ends up with $125,000. Sarah, she starts with 100,000. At the end of the first year, she has 110,000. At the end of the second year, she has 120,000. So who's happier at the end of the second year? Whom do you really think is happier? Sarah. Who should be happier? According to economists, Bob's the happier of the two. Why? Because that's his state. His state is higher, and he should be, right? If I told you 2 years from now you'll have 120 or 125,000, where would you be happier? So, well, obviously we have 125. But why is Bob so upset? Because of the change in his state. And so, he's regretting. Regret is a huge part of human happiness that economists tend to forget. But yeah. And who's going to be gloating the most? Sarah's going to say, "Man, Bob, you're just taking too much risk. You're too much stress." Bob should say, "Yeah, but I got $5,000 more than you do. So leave me alone. I'm still better off." All right. Key definitions we got there. Yeah, discount rates of volatility. And it's also, I should have put in there correlation. So discount rate is a function of the volatility income and its correlation. So make sure you have that. Life insurance is a function of human capital, very straightforward. We'll talk about the optionality in there when we get to the second article. Yeah, we talked about that. Yeah, so I question if financial planners actually do what they said in the article. You can give your opinion on that. A few quotes. So what affects magnitude? Your education, skill, luck, years to retirement. What affects your discount rate, volatility, and correlation? Here's a quote from the article. A person whose income relies heavily on commissions should consider his human capital stock-like because the income is highly correlated. So he should purchase less life insurance, invest more financial wealth in bonds. Do you think that actually happens in real life? What if their commissions are stock brokerage commissions? That person's probably going to have more in stocks because they knowledge. So, we're talking about why did they leave out of the study? What's one of the big things you see in risk tolerance questionnaires is your knowledge of the market. Should they bring the knowledge of the market in? So someone who's a stockbroker, you say, wow, you got a really highly correlated volatile income. You should invest less in stocks. Yeah, but I understand stocks better than the average person. I can handle it better, understand volatilities. So they leave that out of the paper, but maybe they consider the knowledge base of the person investing. Conversely, human capital of a tenured university professor is more bond-like, so she should purchase more insurance, invest financial wealth in stocks. And is that true? What do public school teachers buy? They buy deferred annuities. They put a lot of money into the bond market. Why? Because they're school teachers. I don't know why. I can't answer that. I was a consultant to a private school, and I set them up with TIAA, and yeah, they're all very conservative investors. Just put it in the bond market. It's like, no, I didn't explain human capital. I didn't give them this article, but they just weren't buying it. Why? It gets back to that familiarity. They're just not familiar with the stock market. They didn't understand the risks, so they just stuck with something that was easy to understand. And TIAA sells a lot of annuities just because that's their teacher base. That's the second article. Obviously, risk tolerance is a very easy one. Okay, they're just talking about what they included. Talked about that already. Yeah, my notes, you see there's a lot of overlap in my notes, so you kind of read through it just to see if I'm saying anything new. Yeah, bequest motives, little influence on a person's optimal asset allocation. I do question that one. Obviously, bequest motives is arguably the most important factor other than human capital in determining your life insurance demand. The greater financial wealth, the lower life insurance, more financial wealth also indicates more conservative portfolio. I really don't understand how their model told them that. That's one problem with models is you place that assumption in the model and then the model tells you that assumption is correct because you placed it in the model. So I don't know exactly how they set up to do that, but more research is needed. And then they go through the case studies. You don't need to list the case studies in your paper. Just make sure, there's a case study on wealth or a case study on risk tolerance. You don't need to say case 1, case 2, case 3. I don't need that. Just make sure you talk those components. Yeah, when we get to the second article, we're going to talk about this. When you're reading the second article, be real clear on this. I think it's important to understand, mainly because a lot of financial planners, I think, say it incorrectly. Now, they're going to say, I say it incorrectly, and they need it for me to change. But there's a really famous book, investment textbook, where they have an entire appendix on this point. A lot of financial planners will use the term time diversification. What they're saying is the reason young people can buy stocks is because stocks get less volatile the longer your time horizon. If you're investing for 1 year, stocks are really risky. They can go up, but if you go invest out 20 years, stocks are much less volatile. And what this appendix in the textbook shows you is actually stocks are much more volatile as you increase time. Does that sound right to you? Stocks increase in risk or reduce in risk with your time horizon. A lot of financial planners say no, it reduces in risk. And here's what they'll say. Your return for 1 year might be 8%. And your risk might be 15%. Standard deviation, right? That's our measure of risk. I'm not typing well tonight. But 30 years, your return's 8%, but your risk may only be 7%. How do they do that? Look at 30-year periods and they calculate the standard deviation of those different 30-year periods. What's the problem with that? You start with $1 million. If I can do $1 million. Let's do a 1% case. So here you have that times, let's see, a 1% case is 2.33. Is that right? So you take $1 million plus $1 million times 8% minus 15%. 2.33. Or you take $1 million So you got a 1% chance that your portfolio is going to be at the end of the year between 836,000 and 1.5 million. All right. This is the one that's going to be tricky. take $1 million times plus $1 million times 1 plus 8 minus 7. What are the financial planners forgetting to do? They're forgetting to raise it to 30 years. That's 7% standard deviation. That's over 30 years. And so you get a much different answer, don't you, when you do that? Bill Gates doesn't like that. I did something wrong. I just had parentheses until he shuts up. And then, okay, I think that's right. So there, your difference is somewhere between 2 million and 67 million. I may have a math error in there somewhere. I'm not sure. But anyway, the issue is which one has the wider range? So let's say when you retire, you need to have a portfolio of $4.5 million. What's going to more likely get it to you if you have let's say you have bonds making 5% with a risk of 1%, and you need, let's say you need $4 million to retire. Which of those portfolios, this is stocks, and this is bonds, and if you don't have $4 million when you retire, you're going to be living in a cardboard box somewhere on the street. Which is the more risky portfolio, stocks or bonds? Stocks are, because you have a better chance of not making the 4 million, right, than with bonds. So which is riskier with the length of time? Stocks are more risky. Why? Because the ending portfolio is a much wider range with stocks than it is with bonds. So this standard deviation looks so low. When you compound it over 30 years, your ending range is massive. Now, what did financial planners say? Yeah, but look at the downside's not nearly as bad as the upside is great. So they talk about something called stochastic dominance. Have you heard that term before? I don't know how to spell it. Stochastic dominance, like, yeah, I mean, there's the range is much wider, but stocks so overwhelmingly beat bonds over most period of times. You're going to be better off probably with stocks. So, you know, you got a high probability of having 5, 10, $20 million. But that's not what risk is. Risk is how far you can be from your expected value. That's how we define risk. So stocks over time are more risky because the ending value can be so much different. So be real careful in your paper. A lot of students do this. They'll say young people should have stocks because they have more time to recover and all these kind of arguments. That's not what the argument for young people having stocks. It's not time diversification. It's not having more time to recover. It's not that stocks over the long term are more predictable. It's none of those things. What is it? Human capital is bond-like. All right, that's the key. Human capital. This is more of the second article than the first one, but just make it really clear. Young people shouldn't have stocks because they have all this time. Young people should have stocks because their human capital looks like a bond, and thus they can buy more stocks. And as they get older, their human capital diminishes. So they need to reduce their stock allocation and move more to bonds, okay? So this is one reason I question their opening statement that financial planners take this in consideration, because that's one of the things they say wrong quite a bit. Have you ever heard of financial planners use the term time diversification? And if you haven't, start listening for it. It's pretty common. So somehow you can diversify over time. No, our definition of risk is how far you can be from your expected value. With stocks, that's going to be a much wider. And you might say, yeah, but the upside's so big. Yeah, but if you are targeting a portfolio that you need, stocks are much more likely to be very far from that ending value than your bond portfolio is. Okay. So make sure in your notes, I'm not arguing that point. Okay, I'm saying that's what financial planners say. All right, that's on page 13 in the notes. And here's the Bodie Kane. I don't know if y'all, if any of y'all are looking for a really good investment text, the Bodie Kane is a really good book. It's just called Investments, and you could get an old edition of it. You don't need the most, like, all they do with the new editions is they just update the stock numbers one more year. And you can do that yourself. So it's a really good book. And that book has an appendix that actually shows you the math on this. And I've actually done this kind of math. I had or the endowment at USAA. We ran scenarios where we did 100% stocks, but our definition of risk was the probability this endowment would run out of money. And when you put everything in stocks, yeah, your ending expected value is massive, but your probability of running out of money is really high too. Why? Because you get a really bad market. You're spending this amount every year, you get a really bad market, you run out of money because of the bad stock market, like in the 70s or something like that. So it doesn't make sense just because the ending value is so massive to put all your money in stocks. Why? Because stocks are very risky over time. Yeah, we've talked all those things. Have you ever heard a financial planner? Again, the article implies financial planners are looking at your human capital and assessing whether it's more stock-like or bond-like. I've never had a financial planner do that type of analysis. I've never heard a financial planner say, oh, because you're in this career, you should have less in stocks. Have y'all ever heard one do that before? That doesn't seem normal to me. I don't think they're trained to do that. I don't think it's part of their background. We already talked about this. So y'all know, why is this? Why does the amount of insurance decrease as your correlation to the economy increases? Just see if you're following me. What's the link there? Someone's got to. Y'all gonna depress me right now. Yeah, so if your correlation economy increases, the amount of insurance you buy should decrease. Why is that? It's not tied to wealth. No. I'd have to think about the wealth. It's not tied to wealth. What does correlation affect more than anything else? Huh? Well, volatility and correlation affect what? The discount rate. Higher correlation gives you what? Higher or lower discount rate? Higher discount rate gives you what? Lower human capital, right? All right, so I didn't explain that very well. You got to get that in your paper because that's a big part of the grade. Correlation impact the discount rate. Higher discount rate reduces human capital. Lower human capital reduces life insurance. So everybody have that? Could y'all repeat that back to me? It's very, very important. It's a real key to this entire article. So if you miss that, you kind of missed the entire article. Higher correlation. That y'all remember Bob and Mary? Have y'all already forgotten Bob and Mary? Remember that? Take a picture of that or something. The reason I think students struggle with that is that I don't think it's as intuitive as the article. The article kind of assumes it's intuitive, and it may not be intuitive. And I think the link the students are missing is these two are entirely related to the discount rate. And I don't think the way they write the article, they make it so explicit. So anytime you see volatility and correlation, they're talking about the discount rate. All right. And always remember, higher discount rate means lower human capital. If you got that, you might reread the article with that in mind and just see if it makes some of their comments make a little more sense. I think it's pretty obvious correlation volatility. If it's higher, reduces your stock allocation. That kind of makes it's a little more intuitive. If your human capital is heavily correlated to the economy, you probably don't want to have a stock allocation. But the life insurance link, a lot of people miss that. Yeah, they don't come out and say the discount rate, but that's what they're talking about. So somehow get that in your notes. Make sure you don't miss that one. Right. It's a good article, is dated. I wish if I'm always looking for a more up-to-date one. The problem with human capital articles is while they get the math just gets ridiculous. I think I told you that human capital class, it was a graduate level class. I was trying to listen to it riding my bike. And he's got this formula. I should show you that class. He's got the entire board. It's this one formula. And I'm on my bike trying not to run into a van, trying to look at this, and it's just impossible. I can't follow it, and you can't follow it in words. So the math gets pretty tense. So this article I like because they kept it somewhat tame until the appendix. Right. So on next Tuesday we'll talk about the other. We're actually going to talk all three. You have this second article on human capital, which is really simple. It's only one page, and it talks two issues: optionality and why young people buy more stocks. So we've already kind of got that one. I'm going to talk. I may talk about it now, so you can be watching it in the article. The third article you don't need to read because I've taken it off the rubric, but I'm going to talk about it. So I want you to see it. There's a really important concept in that article, which is biases. But I don't think they cover it very well. So I want to talk about what they say, but cover it a little bit stronger. But then this next article, I think you would actually like this article. David Babel. Really, I don't know if David Babel's still around or if retired. He's probably retired by now. When I worked with him, he was probably 40, but I thought he was 60. So I don't know. When I was 30, I thought everybody 10 years older than me was 30 years older. But Wharton School, obviously Wharton is the risk management capital of the world. That's what they do. So Babel's a really, really highly respected writer, very smart guy. I have it highlighted. Read the whole article, but the highlight, when you get to it, it's something you really want to make sure you get. Here's one place where you can go outside of the article, and I'll show you some. I think I've got it in the class notes. Because this article is so dated, there are some places in this article where you can easily update the numbers. There's one in particular, I might have passed it up, but right.
So when we look at it on Canvas, it should be there.
No, it should be there. I just don't want you to read it as for the. So if you look at the rubric, Article 1's the one we just did. Article 2 is the option. This one is the David Babel article. Article 3 is David Babel.
So it's still there.
No, okay, so this article here was the third article, and I've taken it out. And David Babel's replaced it. So you're going to read the paper is 311, 312, and 314. So you can read 311, 312, 314. I'm going to cover 313 in class, but it's not on your rubric. So that's Article 1, Article 2. Now this is Article 3. And this Article 3 has been taken off.
So in the paper, basically the first Article 3, the Navy puzzle is.
You can don't read it. We'll cover it in class, but don't read it. Yeah. So read 311, read 312, read 314, And I'll talk about 313 in class. Anybody confused on that? Thanks, Catherine, verifying it. I mean, I could put 3 back on if y'all want, but one of the reasons I took this article out is probably a third of the article is replicated in the Babel article. And so it's like you're saying the same things twice. Right? So 311, 312, 314 for Tuesday, a week from now. Let me talk a little about this second article. It's several page article, but you only need really to do the first page. And I blocked out everything you don't need. So when you get here, you're done. The rest of this article is useless because it's very time sensitive about something many years ago that you don't care about anymore. What I love about this article is they make a point, and Brian Jacobson is a fairly famous writer in finance. So he talks about human capital. The first part of the article is, read through it, but the key is when you get to this human capital part. So what does he add that the Ibbotson article doesn't have? And what he's talking about is optionality and human capital. What he says is when you're young, you have more optionality. So what is he saying? You have the ability to change careers. You can go back to school. If your corporation goes under, you can find another corporation to work at. So when you're young, you have more optionality. So you can change careers, jobs, companies. And what the point he makes is some people have more optionality than others. But the other point he makes is when you're young, you don't need optionality in your portfolio. So just invest, don't optionality. Now, you have to see what they mean by optionality. When you're old, you have little optionality. So you need more optionality in your portfolio. So you closer to retirement, I mean, you're kind of stuck. So the question is, what did he mean by optionality? I agree with everything they're saying here. I disagree with their definition of optionality. Right? By optionality, what they mean is active portfolio management. Y'all know what active portfolio management is? So you hire a manager that's trying to beat the market, T. Rowe Price, Fidelity. That's what they mean by optionality. So essentially what they're saying, when you're young, just buy index funds. But as you get closer to retirement, go hire more active managers. And y'all can guess what I think about that. My view, optionality means options, mean like investment options. I'm talking about the actual security of options. You know what stock options are. We'll talk about them more when we talk about annuities. I actually believe people in their 60s and 70s should be hedging their stock portfolio with options. It makes a lot of sense. So, in fact, when interest rates were like 0.5% a few years ago, I was like, 70-year-olds shouldn't even buy bonds. They should put all their money in the stock market and just hedge it. Because why would you buy bonds making 0.5%? So put all your money in the stock market and hedge it. So how do you hedge it? What do options do? Where options are like insurance. So you can buy hedges on your stock portfolio to protect yourself so you can't lose more than, say, 10% or 15%. You can put a floor on that. That's something that an older person needs. A young person doesn't need that. right? Because most of their net worth is in human capital, pretty stable. They can take the volatility of the stock market because it's a small part of their portfolio. So they can just let that fly around. They almost want volatility because then, if the market crashes, they can just stick a little bit more extra money in there. And they want the market to crash when they're young anyway, because they're buying at a low point. So a young person shouldn't be buying options on their portfolio. Why would you buy? That's expensive. But an older person should. In fact, I believe an older person can have a higher stock allocation and hedge it and end up with a better return with less risk if they do that. So I disagree with them on the application. Why? Because I don't think active management adds any value. So I'm pretty extreme on that. I think you're wasting your money on active management. Active managers don't really protect your risk. Active managers just make a lot of money off of you, and you lose just as much money as you would. So I love the concept, makes a lot of sense to me. I hate your application. Now, should you put my definition in there? I think it'd be good. We'll talk about it more next Tuesday. Yeah, Professor Sweet disagrees with this because I'd love to see that. And then after that, you can say, I disagree with both of them because, and you can put that in there. Or, if you think you can get brownie points saying, I think Professor Sweet's right. I actually prefer it when students disagree with me than agree with me. But, if you want to butter me up, that's fine. Professor Sweet, such a brilliant idea there. But I would at least acknowledge it so I can see that you understood that. We'll talk about it more on Tuesday, but I want you knowing this as you go in so you see what they mean by that optionality. So up here, the optionality is the ability to change careers. Here by optionality, I mean active portfolio manager. I see it better as actually buying hedges on the market. If you want to think at that time, hedging stock market losses. You think life insurance is the perfect hedge for human capital. Stock options are the perfect hedge for stock market crashes. I mean, it's perfect. If you buy put options on the S&P 500 and it falls 20%, you're going to make a lot of money on those put options. It won't maybe a perfect hedge because there's a cost to buying them, but it's definitely going to be a -1 correlation kind of thing. All right. So this week, if I were you, I would get all of this written. Now, someone was asking about format. So I don't grade on format. So whatever format you want to use is fine with me. But if I were you, I would start using, I would stop writing college papers and start writing professional papers. So some of you have seen these before. I'll show you one from a previous class. It's very similar to the article you just read, right? An abstract. This is what I'm going to do in this paper. And I like 2 columns, single space. You don't have to do that, but 2 columns, single space, very narrow margins, make it look like it's published in a financial journal. Just my recommendation. If you send me 1 column, double space, you don't lose any points. However, I would never put a paper on LinkedIn that's 1 column, double space. Guess what that looks like? It's like a college student paper. What don't you want your work to look like? A college student paper. You want to look like a professional in there. So make it look professional. Why do students do single wide margins, double space, 1 column? Because they get more pages. I don't grade on number of pages. I don't even notice number. Students ask me how many pages long should it be? And I say long enough. Try that with your first boss. Oh, you want me to write this for you? Can I do 5 pages? I really don't want to do any extra work. So, I mean, I'll do 7 if you want it, but no, you don't ask your boss how many pages. Don't ask your professor how many pages. Long enough. That's part of the critical thinking, right? If you come in with 80 pages on this first paper, you probably did something wrong. If you come in with 2 paragraphs, you really did something wrong. So somewhere between 2 paragraphs and 80 pages is about right, somewhere in that range. But that's part of you're a college student. You should be able to figure out how many pages a paper should be on something like this, right? But if you do 2 columns, narrow margins, and one and no extra lines, then it's gonna be fewer pages, probably half as many pages as the other approach. The other thing to be real careful of that I do count off are is length of paragraph, which is one reason I really hate double space. It makes it so hard to read the paper. So if you're doing 2 columns and single space, once you get to about 10 to 15 lines, the paragraph's getting too long. If you're not sure, break the paragraph. I should bring one paper in a student submitted. It's been a few years, but it's like a 4-page paper and it was all one paragraph. And there's nothing worse than reading that. Sometimes I'll take your paper and I'll put paragraphs in just because have you ever tried to read something with no breaks? You can't, you look down to do something, you look back up, you got to almost read the whole paper again to find where you were. So make it look professional. Massive paragraphs just don't make sense. That's kind of the downside of the 2 columns is paragraphs look longer, but that kind of helps you because when you have it 1 column, paragraph gets too long, you don't really notice it. With 2 columns, that 10 to 15 lines starts looking kind of long. And so it kind of forces you to break it up a little bit more. So if you're not sure, just put a break in somewhere. Definitely don't have 2 or 3 major thoughts all in one paragraph. A paragraph of 1 or 2 sentences is fine. So, you're better off breaking it to start a new idea. Don't try to conserve it. Short paragraphs are fine. I don't know if there's any in here. Yeah, I mean, that's a pretty short one. The other thing they do, I don't like exactly how they do it here, but because they're too narrow on the margins. But if you have a long quote, separate it, italicize it, center it, but don't narrow your margins. Keep it pretty wide. It's really hard to read a quote inside a paragraph that's that lengthy. So you're better off breaking it out. But I don't count off on any of that except for paragraph length. If your paragraph length is too long, I'll count off for clarity because it's just an absolute pain to read that. Right. Does that answer someone had the question on formatting? Does that answer your question? I could put one of these papers on our drive just so you have an example. Do y'all need? I mean, it won't be the paper for our class, though. If I put one of these out there, would that help you any? Just to see. Okay, I'll try to do. I'll find one that looks really good. I may not be tonight, but maybe tomorrow.
Title. We have to come up with something entitled. Do we come up with something creative or?
Well, what really helps on the first paper, but even more on the second paper, is it helps me. You don't have to do it for me, but it helps if your titles follow the rubric pretty closely. That really helps me a lot, but you don't have to do that. Whatever is logical, but the second paper, a lot of students actually, their titles are the rubric. And you just go straight down. It doesn't make sense to do it in the same order as the rubric on paper 2. It probably makes sense to reorganize it, but it certainly helps me to know that, yeah, this is what you're talking about here, but don't have to do that. All right, any other questions? So Thursday, we'll go back and talk about more on the economics of life insurance, talk about the industry. So let's talk bigger, just insurance itself. So we're in the private insurance business. So these are private firms. Sometimes governments can provide this type of insurance. We're not going to talk about that in this class, but things like workers' comp is often a government product in some states. Very rare on the life insurance side for that to be the case. Obviously, Social Security is an insurance product that's offered by the government, but that falls under social insurance. But when states provide workers' comp, it's like the state is a private business, but operating. So it's a little bit different. There's a difference between workers' comp offered by state and Social Security offered by the federal government. So this is a contractual relationship. You actually have a contract in place. Social insurance, we'll talk some about. There's some pretty interesting things going on with Medicare right now. So we'll talk about those and their impact on the insurance markets. So we're not going to study Medicare, Medicaid, Veterans Administration in detail, but we're going to look at them, how they impact the insurance world and how they impact health care itself. And then there are public guarantee associations, things like the FDIC and those type of things that are insurance. So our focus is on the private side. The private side is the life insurance side, which includes premature death and living too long. So we tend to have life insurance and annuities in the same group. We'll talk about deferred annuities, which is really not life insurance. Deferred annuities is really an investment vehicle that you're just saving because of tax advantages, but it's not any different than any other, putting your money in a mutual fund or something like that. So deferred annuities really are just an investment product. But immediate annuities, where they say we're going to pay you $500 a month for the rest of your life, like Social Security, that's a true annuity. And then health insurance, we'll talk quite a bit of that. There is some health insurance under property casualty, under the workers' comp side, and you will occasionally, you look at a property and casualty company, you actually see health insurance. Health insurance used to be part of property and casualty, and then it got split off to the life side, but a few companies still have a little bit left over. So, but most health insurance is going to come here. And I think today, health insurance companies, that's what they do. I have, who was I? One of the guys from this class, he got a really good job because of this class, because it was, he's doing like compliance and regulatory stuff for an insurance company. Aetna is one of his customers. And I said, Aetna, that's mainly health insurance. And he said, yeah, they do a little bit of other things, but yeah, it's predominantly health insurance. Health insurance is such a difficult business. It tends to be specialized with a few big players. And now it's becoming, there's more people that are providing the insurance and providing the services. You think of Blue Cross Blue Shield and some of these, and Humana. So health is a little bit different. A lot of companies do life insurance, but don't do any health insurance whatsoever. And then we're not going to do property and casualty here. Property and casualty is either property or liability coverage or a combination of the two. Interesting thing on property and casualty, though, is you might buy auto insurance from State Farm. They really see it as two products. You got the property side and you got the liability side. So that they even show it on their books. It's auto property and auto liability as two different products. You don't notice that because you pay for it all together. So we're not going to talk about any of those. Reinsurance is not that big of a deal on the life insurance side. So reinsurance is when insurance companies buy insurance from another insurance company. Anybody know a big reinsurance company? Have you heard of Swiss Re? So if I were an actuary, I want to work for Swiss Re. It's my favorite company of all. Wonderful company. I don't know if they're the biggest. You also have Gen Re. Who owns Gen Re? You may know that. We talked about it last semester in my P&C class. You read an article about it. Your first paper. You remember your first paper, Humbert? About float? What company was that? Berkshire Hathaway. Yeah, they own Gen Re. So Berkshire Hathaway is a big insurance company, but not on the life insurance side. Really just on the property casualty side. Life insurance does reinsurance, but it's really just they're trying to save expense. It's not a major thing. Whereas on the P&C side, it's a huge part of their risk management. All right, the functions, you have production, probably my least favorite part. We're going to talk about the ethical issues, and that's where all the commissions come in. Production, marketing, sales. I was talking to a student who did some of that I think I won't say the company he was at, but he's like, yeah, I had to do like 100 cold calls, and like 3 people would answer out of 100 calls. And it's like, yeah, that sounds really miserable to me. And he was all excited. Oh, that's a great job. I was like, man, that sounds like a horrible job. But he kind of, some people like the sales side. I mean, when you pick up the phone and someone's selling life insurance, what's the first thing that goes through your mind? It's like, how do I get into this call? Or, hey, wow, that could be really good. I really need that. Is that the first thing that's your mind? It's like, gotta hang up. Sorry, bad connection. All right, underwriting. I had USA's underwriter come and speak to us, but I can't get him to come back again. He's just working too much overtime. Really interesting guy. So underwriting on the life insurance side is very different than on the property casualty side. But let me mention one thing with underwriting that you might say, what's the difference between underwriting and actuaries? So the underwriters are the ones who figure out the risk. Are you a standard risk? Are you high risk? Are you some kind of special risk? They're going to do that. Well, that sounds like actuaries do. What actuaries do is they price each of those risks. The underwriters then got to figure out which of those buckets that the actuaries created, which of those buckets do you fit into? So they select and classify exposures, whether they're good or bad, whether they're some substandard risk or normal, preferred, whatever, are uninsurable. So essentially what they're trying to do is get data and based on the data, figure out where you fit. And then the actuaries want them, the actuaries underwriting work very closely together. The actuaries want to say, hey, make sure you don't put them in the wrong bucket because that's going to mess up all of our data. So sometimes it's pretty obvious. It's going to be age, gender, it's going to be driving history on the auto side, it's going to be family history on the life insurance side, and maybe some blood work you have to do, those kind of things. So that's what an underwriter does. Their goal is to protect the firm from anti or adverse selection. We'll talk about that. It's unhealthy people buying your life insurance. How do you prevent that from happening? And where they work on is they have the application, which you fill out. We had a big debate at UTSA when I was there. Can you sell life insurance over the internet? People just filling out applications. How do you protect yourself from really, really sick people buying life insurance? If they lie on the application, you're okay, because if they lie, they lose the insurance. You give them their premiums back. But how do you protect yourself from that? You might have an agent or a broker that's going to collect information for you. Investigation doesn't really apply on the life insurance side, but on the property casualty side, you might actually go out and inspect the property, make sure certain things are in place. Information bureaus, do y'all know these guys? You've probably heard of this one. Have you heard of Equifax? So one of our former students, I need to call him. They had not hired, they had interviewed in colleges ever. This firm had never hired a college student. They'd only hired, so finally they decided to go interview at colleges, and they interviewed at UTSA, and they hired this student. It's like, okay, their first hire is a UTSA grad, and now they're fighting over him. He's doing really well. His boss left, go to another firm and try to take him with him. So he's doing a great job. So he's really proven himself. But they do a lot of this kind of data. You think of it for your credit score, but they do a lot more data than that, where they help insurance companies collect data. So they have several different divisions that do different things. I remember being accounts payable at USAA, and you pay these entities a lot of money. They're a big part of their expense. So that's there. Obviously, on the life insurance side, you may actually have to go in for an exam or do a blood work. And insurance companies have what they call select and ultimate tables. The select table is you get a really good rate because you just went to the doctor. Ultimate is you're 3-4 years away from the examination, you're going to pay a higher rate. So that's select and ultimate. Now, what is an underwriter? Well, it can be a finance major, it can be an accounting major, it can be a liberal arts major. They hire all major. They do want college degrees generally. I don't think they hire non-college degrees. If you are an actuary or a finance person who wants to work in this industry and you can't, like actuaries, you got to get those first 2 or so exams before they hire you. If you're still working on those, underwriting is a great place to start for an actuary. You really learn a lot, and it's not a difficult. There's a lot more jobs there, especially on the property casualty side. There's a lot more of them, so it's a little easier to get your foot in the door. And then you're learning things that are going to help you as an underwriting. Help you with underwriting. If you're finance, you're really getting to see the guts of the company. So it's a really good way to learn the company as well. So if you can't find a job, don't stick with your major. Underwriting is one of those fields that they'll hire a lot of people. It probably pays as well as accounting or finance jobs to start out. It just doesn't have the growth that finance does. So, you don't want to be there for 10 years, but 2 or 3 years will definitely not hurt your career. Now, the guy that we spoke to us, he took this class. I just had to tell you his story because it's a really fascinating guy. So, he sent me I interviewed him at USAA for a finance job. He gave me his resume. His resume was, he's a heart surgeon, and he could not list all of his patents in his resume because they were still pending. I was like, okay, I haven't had students list patents before. So he had a special needs daughter, and he just wanted to stop being a surgeon, and so he took finance classes. And so what I recommended him do is go talk to life underwriting. And he did, and they hired him on the underwriting side. He was really intimidating because the head of the department was a doctor, and here you have this doctor who's done heart surgery come in, and eventually he took that guy's place when he retired. So he's the head of that department. But it was pretty funny because he's invented like EKG machines. And one of the questions on the application was, do you know how to read an EKG machine? He's like, yeah, I do heart surgeries. Yeah, I think I can handle that. But think how valuable that is. Someone comes in and applies for life insurance and they've had some medical issue. A doctor like that is going to be able to really assess and know what numbers to ask for. So very impressed. I wish I could get him. Maybe I should email him again, see if I can get him to come speak to us. But last time he was like, no, I'm just too busy. So we'll see. It's a fascinating area. He went through the entire process and he didn't finish his presentation because there were so many questions. It was really quite fascinating. The data they look at and how they decide. All right, then you get into the claim side, the loss adjustment. Here's where someone has said they had a loss and you got to make sure it's not fraudulent, that the loss is actually there. Life insurance, for the most part, if you have a death certificate, that's all you need. Now, sometimes they investigate. There's a few cases we might talk about. There's one really famous one, and I think it's is it Forensic Files, where they do the real life crime stories? So this is something, it's called the True Case, TRUE. It's a really bizarre case, but USAA was sued as part of the case. USAA is in the Forensic Files. If I told you the story, you wouldn't believe it because it's just too bizarre. But it's a case where the guy died, and the whole thing was, how did he die? His wife said that he was attacked by the mafia and they killed him in his car. USA said that he committed suicide. So it was this big battle and what are the data, and it's a bizarre story. So if I can find that one, well, I might show you excerpts from it because it's a really bizarre story. USA doesn't get sued that often on the life insurance side because it's rare, those type of cases. But a good friend of mine worked in the cash management side, so he actually paid the claims. And he's a really funny guy. So he tells these incredible stories and he has everybody laughing, but it's the craziest ones are the double indemnity. I don't know if y'all know double indemnity. The lady who killed her husband with Tylenol, she was a double indemnity. I don't know if y'all have heard that story, but the Tylenol crisis happened. So this lady say, hey, that's a good way to get rid of my husband. So she laces Tylenol, kills him. Unfortunately, the medical examiner didn't find the poison. So he said he died of natural causes. Well, she had a double indemnity policy. If he died in an accident, she would have gotten twice as much money. So now she's got this problem that she's killed this guy. She's only going to get, I don't know, 50,000. But if he died by the poison in an accident, she'll get 100,000. So how does she do this? So this lady's pretty evil. She laces more Tylenol and puts it on the shelf in a local grocery store, kills another lady. And then after she kills that lady, she goes to the police and says, hey, I'm wondering if my husband might have had that same problem because we had Tylenol from that same store. And that's how they found her, because she accidentally put some of her fish food into the Tylenol and they traced it. So it's bizarre stories, right? When you get the life insurance, people do bizarre things. And if your significant other buys a double indemnity policy on your life, you're going to die a horrible, disastrous death because they have to make it look like an accident. So, but he had a lot of stories like that. It's just amazing what people do to get, like, I mean, life insurance is a lot of money. And I mean, I don't know you've heard those ladies that were buying life insurance on the homeless people and then killing them and collecting. I mean, it was just bizarre stories. So when you have payouts of $500,000, $1 million, people do some crazy stuff. So you do have to investigate. So you get the death certificate from the insured, or if you have someone that passes away with life insurance, you call the insurance company and that gets the date of death. And so you don't have to pay any more premiums, but you want to make sure you have that documented. So when you don't pay the premiums, you don't want the policy canceled. So you call, it can take quite a while to get the death certificate. It's not like 2 days later, so it can take weeks. There might be an investigation, but generally not. Proof of loss, again, the death certificate. And then they'll either pay or deny the claim. If they deny the claim, there's a really massive process that you can go through with the state regulators and others to say, hey, I think they did this fraudulently, or you can sue them and do that the same way. On the True case, that's what happened when her husband died in a car accident, and they made it look like, you know, they wanted to, or maybe that he was killed by the mafia. She sued USA for not paying the claim. USA's case was that the coroner ruled it as self-induced, not as murder, and so that's what USA had, so they went with that. So anyway, if you want a pretty interesting job, then you know the claim side of life insurance works well. On the P&C side, it's very, very different. So I've had some actuaries start on the claim side. It's not a bad way for an actuary to start. It's not the most fun job because when your claims on auto insurance, everybody calling you is really mad because they just had an accident and your customer hit them, and so they're mad at you. They're mad. They think you're going to rip them off. So everybody's pretty irate. So it's really hard to take phone calls like that all day long. The life insurance side, it's, you know, you're talking to people that are not angry, but they're sad, and you have to make sure you use the right kind of response. But you do learn a lot about the insurance company on the claim side, probably more on the P&C than on the life side, but you do. So underwriting and loss adjustment are not bad ways to learn these companies. But obviously what really distinguishes insurance companies is actuaries. They price products, they set up reserves. There's more jobs on the P&C side. But on the human capital optionality, there's few optionality. If you're a P&C actuary, you'll probably be a P&C actuary your whole career. The life actuaries, because there's so much more investments on the life side, life actuaries can easily switch to the investment world pretty easily. Now P&C actuaries can flip out of actuary and go into decision science. That's there's a decision science department at USAA, and it's PhDs in math. It's actuaries. They have a few finance people. It's a collection of those people. So there are some actuaries that just said, I don't want to do actuary anymore. I'm going to do decision science. So, you know, either way, if you're really interested in investing, though, as an actuary, you really want to try to get on the life insurance side because you can radically change careers, you know, 10 years in. It was really irritating to me. The actuarial exams are really hard. Some of y'all know that, right? Really hard. Well, a bunch of actuaries at USA started taking the chartered financial analysts, which is my, you know, CFA, and they were passing it like they were doing first grade mathematics. It was really irritating. It's like, couldn't y'all like fail it maybe every once in a while? And they just found it's a really hard exam. I mean, I have the CPA and the CFA. CFA is a lot harder than the CPA, but the actuary is like, forget it. Anything compared to the actuarial exams is easy. And so they were getting their FSA and their CFA. You can kind of name your salary once you do that because that's a really impressive combination of things. My first boss was a CPA, CFA, and FSA. He had all three of them. Yeah, so life gets you more on the investment side. I would not want to be a benefits actuary right now. That's a job that is very dependent on the U.S. tax code. Any major changes there, and they may not need you anymore. I don't like jobs where, you know, you're 90% of your job is U.S. tax code. You're just like hoping they don't make any changes. There are actuaries that can work on the government side. For the statistical side, the starting pay is the same, but it doesn't rise nearly as fast as it does on the corporate side. And then you do have the asset liability management function, especially on the life insurance side. A lot of interest rate modeling, a lot of stochastic modeling to try to understand your risk. The property casualty side is more modeling hurricanes and earthquakes and that kind of things. So they're great jobs. My favorite part of my job is working with the actuaries. I get myself in trouble, but the life actuaries were very different people than the P&C actuaries. Now that might just be USAA, but personalities, all the life actuaries had the exact same personality. The P&C actuaries were not all the same, but very different than life actuaries. So it just depends. Probably has to do with, life actuaries are doing a lot with mortality and morbidity and, kind of gruesome things. So they tend to be a little bit more stoic kind of people. They just, so anyway, I don't know, you actuaries is the idea of I'm going to work where they offer me the job, or are you aggressively seeking one over the other? Do y'all know what you want to do yet? So you got to get, how many, is it the first 2 exams you have to get? And the first one's just a pure math, isn't it? Just have to get the math. So, huh? Yeah, there's probably other maths coming up. On the life side, you're going to get the interest rate theory stuff, which is pretty difficult mathematics. Yeah, between the P&C and life, I don't know. I really had a blast working with the P&C side. It just seemed like there was more stuff, more variety going on, but I don't know. It's either would be fine. They're both great careers. And then the investment side, which is where I worked, you collect your premiums today and you're going to pay off claims in the future. So you got to invest it until that time. The P&C side and life side are a little bit different animals. The life insurance side is more like a bank. It's more of a spread business. They make 6% on their investments and they pay 4% on their annuities, or they pay 4% on their life insurance. It looks more like a bank. The property casualty side, they don't pay interest on auto claims. So it's kind of an implied interest. So it's a little bit different. My job on the property casualty side was to tell them what the investment portfolio would earn so that they could price the P&C product. On the life insurance side, it was really about which assets best match up against that liability. And especially interest rates were really important. The P&C side ignored interest rates for the most part. The life insurance side was all about interest rates. They all have their complexity. We're going to see on this one later in the class, we're going to talk about how deferred annuities are short straddles on interest rates. Y'all know what a straddle is? Anybody know a straddle or a strangle? How do you create one? Using,
They call it, right?
you buy a put, buy a call. So if nothing happens, you just lose money. But if things happen, you make a lot of money. What if you're short a straddle? It's the exact opposite. You make a lot of money unless things go wild and you lose a lot of money. So life deferred annuities are like short straddles on interest rates. They do really well as long as interest rates don't move a lot. If interest rates move a lot, what have interest rates done the last 3 years? They've moved a lot. So it's an interesting time to be on the life side. This is something big that actuaries do because this is a huge risk. I remember we had a brand new CEO and we showed him our short straddle. And I'll show you one. I've recreated what we used to show at USA. And he looked at that and goes, who would ever sell that product? And they said, well, the part where it's positive, that's really a high return. And he's like, yeah, but the part that's negative, we go insolvent. So he's like, yeah, but focus on the little part that we make money. So he was like, I don't know why we'd buy that, but it is a very profitable business, except for at the extremes. And it really does blow up at the extremes. So questions on that, a lot of careers there. Obviously, normal staff functions, accounting, all that kind of stuff is there. Legal, obviously there's a lot of lawyers and life insurance companies. But these are the jobs that really stick out in the insurance side. I don't know if you're an actuary finance starting on the marketing side, I'm not sure that's going to help your career. You're much better off on the claim side than you're on the marketing side. That'd be my recommendation. Maybe it's just I hate sales so much. The insurance industry has some unique legal forms. So if you look at a firm like Prudential in the United States, that used to be a mutual, but now it's a stock company. It's just a regular stock company. MetLife is a stock company. And these are substantial companies. They're not like, so let's set up some comparison here. So I mean, know the assets of JP Morgan. Over a billion, over a trillion. So here's the balance sheet. So $3.7 trillion. Does that sound like a big number? I always tell students, some of y'all heard this before, but it still amazes me because I remember sitting at my desk and State Street Bank was the first bank to hit $100 billion. And I still remember sitting and going, $100 billion in one bank. That's just crazy. How can one bank have $100 billion? And here we are, you know, a couple of decades later and 3.7 trillion. Why? Because what's happened in the last 30 years? Major consolidation of these banks. $3.7 trillion and not even $300 billion in net worth. Banks are levered 10 to 1. How much room for error do they have? Not much, right? So let's look at Met. I think Met's the largest. Met is only, whoa, that's a bad looking numbers. $760 billion. Not even a trillion. And that's, I'm pretty sure that's the largest. We can look at Prudential. No, Prudential's large. Wow, look at that. That's pretty amazing. What happened in 2022? Interest rates rose, bond prices fell. Look at their net worth. Their net worth dropped in half. You see the short straddle we're talking about. That's pretty amazing. Yeah, their net worth dropped in half in 1 year. Not much room either, is there? They weren't even, they're like more like 12, 13 to 1. These are very levered. I mean, if you don't think that's a lot, look at Walmart. Walmart is what? 4 to 1 or 3 to 1? $3 of assets for $1 net worth. MetLife is, I don't know what that is, or Prudential. 22. Is that like 20 to 1? You know, that's a massive leveraging. But the insurance industry is not as big as the banking industry as far as these massive city banks and those types out there. So those are stock companies and they have tickers, so you can trade them as stock. But there's also mutual insurance companies. A mutual insurance company, you can't invest in it. It's not a publicly traded company. It's owned by its policyholders. So State Farm is a mutual. Northwestern Mutual is, guess what? A mutual. Mutual of Omaha is what? A mutual. Mutual of New York is what? A stock company. I tricked you. What does Mutual New York go by now? No, New York Life is a separate company, but Mutual of New York is now known as Money, MONY. So they went from being a mutual to a stock company. So a mutual is owned by its policyholders. A mutual can what's called demutualize, which means convert from a mutual insurance company to a stock company. You have to get approved by the state, and essentially what you have to say is you have to you create all these shares and you send them all to your customers. So all your policyholders become stockholders. You don't actually go out and issue stock. You actually just give stock to your customers. So the state has to know how you're going to distribute this stock to your customers. So my dad had a Mutual of New York policy on all of us. And so we all got, 6, 7 shares of Mutual of New York's stock in the mail. My dad thought that meant they canceled his insurance. He said, well, instead of the insurance, you can get these stocks. But no, we still had our life insurance, but we also had shares of stock. And then my brothers are all debating, well, do we hold on to it or we sell it? And my answer to that question is, were you going to buy the stock anyway? Were you planning on buying the stock? No, we have no plan. Well, then why would you hold on to it? If you weren't planning on buying it, why would you keep it? Just, so sell it, get rid of it, forget about it, because you had no interest in it. It was only a few $100s. It wasn't worth it. So you can start off as a mutual and become a stock company. Why would you do that? Well, because you get access to the stock markets. You can get access to cash much more quickly. Some people think it's because stock CEOs get big stock options that you can't get when you're a mutual insurance company. So it might be CEO pays the bigger part. Reciprocal, there aren't many of them. USAA is probably the most famous one. Farmers supposedly is one, but Farmers is really confusing and strange. It's on the property and casualty side. A reciprocal is essentially a mutual, but it's a mutual with some special rules. The biggest thing with the reciprocal is the tax law. Reciprocals have humongous tax advantages that just blew me away when I went to USAA. It's just it's amazing. They don't maximize it. They could really take advantage of the tax code. They just haven't because they're worried if they really push it that the IRS will take it away. But they do get a pretty big benefit from being a reciprocal. The biggest advantage is they have net worth. Some of their net worth is their net worth. The rest of their net worth, they can actually allocate it to their policyholders, like a savings account, but they don't have to actually give it to their policyholders. They just say, hey, I set aside $500 for you. They get a tax deduction when they set that aside, even though they don't pay it to the customer. And so if they make $1 billion, they can just set aside the $1 billion to their customers and pay zero tax. So it's a huge tax advantage. They have that over State Farm, over anybody else, but they don't maximize it. Different pricing structures. We're going to talk about par versus non-par on the life insurance side. There are P&C products that are participating, but it's rare. I mean, USAA has kind of a participating auto insurance policy, but it's much more common on life insurance, and we'll talk about participating. And then distribution systems. So you can have independent agents that just sell insurance for a bunch of different companies for a commission. The direct writers like USAA, like Geico, those type of companies, I think Progressive might be, I'm not real sure, but the direct writers, they don't have commission sales forces. They have salary sales forces. They deal over the phone, over the internet, through the mail. USAA used to be one of the biggest direct writers out there. So I'm sure it's not true today, but they used to mail more pieces of paper than almost any company. If you ever visited the post office, they had one room just for USAA, and all the stuff came and went out from that room. But that's probably not true today. I don't get much stuff in the mail from US. In fact, they asked me not to get stuff in the mail from them. They beg me to do everything electronically. But still, you can be a direct writer over the internet. Then you have like a State Farm exclusive agents. So you've seen the little State Farm boxes, right? That's all they do. They just sell for State Farm, so they're exclusive agents. And then you have brokers. Brokers are not agents. Brokers work for themselves. So an agent, they're not an employee of the company, but they can legally bind the company. A broker can't legally bind the company. The broker essentially generates business for the firm. The firm likes the business. They can take it and they'll pay the broker for bringing them business if they don't like it. So the broker can't bind the insurance company. They can just say, hey, here's some customers that want your product. I brought it to you. Give me a commission. And the company says, well, I like these 5, but I don't like these 2. And they say, okay. So that's how a broker works. So commission or fee for service. All right, some great websites. NAIC are the regulators for insurance, and they have a website. It's pretty well organized. If you want to know what are the biggest issues facing insurance right now, there's going to be a topic discussion, probably some good papers out there. AM Best. If I were an actuary, I might want to work for AM Best too. Really great firm. They're a rating agency essentially, but they have actuaries because they're rating. Their main thing they rate is insurance companies, life insurance and property casualty. So it's a rating service. They also publish a magazine that UTSA used to have. I don't think they do now, but it's called AM Best. I remember visiting AM Best once, and they have a campus a lot like USAA. The whole culture felt like USAA, very collegial, very friendly. So it's a nice place to work. I don't know if it'd be a starting place or if you work in the industry, Wall might be a good kind of second career to go to. Probably pays pretty well. Very well respected firm. And you can see they have some pretty good links. So yeah, I really enjoyed working with that firm. Very friendly firm. Now, do y'all know who the ACLI is? Have you ever heard that term before, actuaries? So this is essentially it's kind of a trade group or a industry group for the life insurance industry. Discover the industry, life insurers, state fact sheets. So they're there to represent and endorse the life insurance industry. They do some really good work. I don't know what kind of jobs they have. You might look and see what kind of people they hire. It might be a good job when you're in your 50s and you just want to kind of have a nice, easy, high paid, easier kind of job that's not so stressful. But a lot of good topics in here. So these kind of sites you can go to if you're about to interview with the industry. You just want to have some gee whiz things to talk about, some issues that the average undergraduate student wouldn't know about, and go and look into it. So topics: consumer protection, economic empowerment, those kind of things they'll look at. Y'all know what SOA is? Society of Actuaries. Same thing, a lot of white papers. What is it on the P&C side? The what? CAS, that's right, Casualty Actuaries Association. I've spoken to the CAS conferences. I've never spoken at a SOA conference because I'm just not smart enough to talk on the life side. They know investments as well as I do, but I can get away with it on the CAS side. So these are good places to go. Just show that you're aware of them and you've been out to their sites. And there's another one out there I forgot to put out there. It looks like Bean Actuary, but it's not Bean Actuary. It's Be an Actuary, but Bean Actuary. That's a great site. Do y'all use that at all? The actuarial side, if you've been onto it. So they probably have information on the exams and those kind of things. So they're trying to, push the career. Why actuarial science? What is an actuary? How do I get started? So probably a little too basic for the actuaries in here. But actuaries is a very unique field, very kind of tight-knit group. They know each other. I was really amazed with the actuaries. They know what everybody's doing. So it's an interesting group. Very technical, obviously. So they're all very quantitative people. All right. Good industry with the one exception of what? Ethical challenges. So this industry, you can read my blog. My blog is quite negative. One student on Saturday said, "Hey, yeah, I really like your blogs because you're just so honest." It's like, I don't know if I'm honest. I'm just, I just like to rant, but so I don't know how far back you have to go to find it. Yeah, that's not it. So anyway, that's not industrial. Complex is probably the word. There we go. The financial services industry, buyer beware. I do talk quite a bit. So you might read this. I'm going to tell you Danya's story, and that's one of the stories I tell in this. Why I'm so named. I don't write short blogs, although I'm trying here recently to write shorter blogs. But I do want to get into my recommendation how you handle this industry at the end. So we'll come back to this. I'm going to show you how someone can get through an industry that is this ethically challenged. So maybe stepping on toes if you work in this industry. but at least you hear my side of it. This is going to be a question on the exam. So you have to give my side of it. You can disagree with it. If you want to waste time on the exam, you can even give me your side of the story, or you can just say, I disagree with everything you said, but here's what you said. You can certainly do that. If you know someone who strongly disagrees with me, wants to have a public debate, bring it on. I'm all ready for that. So my key is that you see it in the context of history and what happened, because this hasn't always been the case. Before 1980, it's a pretty boring, straightforward, simple. The word simple is really important. Very simple industry. Had commission sales agents, which I don't like, but not nearly the ethical issues they have today. And so something changed. And so what changed? So understanding the late 70s, why did this industry shift so radically from being insurance to being an investment firm? Why did they do that? So before 1980, this was essentially a two-product industry, term life insurance and whole life insurance. We're going to talk about term and whole life, but we're going to add a whole bunch of others on top of it that have come along since the early 80s. So term is, you buy insurance for a year. If you die in that year, you get paid. Your beneficiaries get paid. If you don't, you can buy another year, or you can buy 10 years worth. And if you have insurance for those 10 years. Whole life, you pay a fixed premium until you die. If you die at 22, you get it at 22. If you die at 90, you get paid. Your estate gets paid at 90. Real simple. You can't get much more simple than that. Pay $80 a month till the end of your life. As soon as you die, we'll pay the death benefit. Very, very simple. Very easy to compare. And then something happened in the early 80s. So first of all, you don't remember the 80s because you weren't around then, but I remember the 80s. Very, very, very high interest rates. Very, very high inflation. I can even show you. I was showing my other class, showing Riley's class this. Let's try 79. So their 3-month treasuries are at 12%. The 5-year treasury was over 10%. Would you buy 5-year treasury at 10% today? You can't get a 10% CD, can you? So really, really high rates. I don't know how further back. Whoa, that's a very unusual yield curve, isn't it? So yeah, we're getting a little higher. I don't know exactly the spot. Boy, just wild yield curves all over the place. But anyway, double digit in interest rates. So term insurance, not a big deal. But whole life insurance, these are products where people were investing. We're going to talk about whole life. It's essentially life insurance with an investment. And the investment had an interest rate to it. And the interest rate at that time was like 3%. You got this life insurance product policy that's paying you 3%, and bank CDs are paying over 10%. Like, why would I buy life insurance? I can get 10%. I had a 15% CD. There's this ridiculous interest rates back then. And so you had what's called disintermediation. If you think of banks and insurance companies being financial intermediaries, bringing borrowers and lenders together, disintermediation means you're moving between these different intermediaries, moving between banks and life insurance companies and investment firms. So the insurance industry, life insurance industry, saw a lot of money leaving them and going to banks and investment firms. The first one was related to interest rates. Interest rates were so high, people were saying, and what was happening at the time is when you have a whole life policy, you're going to see we have something called a cash value, which is your value in the policy. If you got $40,000 in a whole life policy paying you 3%, and you can borrow that $40,000 at 3% and go buy a bank CD at 10%, people are taking their money out and buying the bank CD, And it's like, if I die, I still have more money because, it's like, there's no way I can lose. Well, the insurance companies were saying, okay, this money's coming out, interest rates are high. We're having to sell bonds to fund this. All of our bonds are underwater because interest rates are up. They were just losing left and right. And so they were losing to the banks. And then in the 80s, the stock market took off. And so now they're losing money to investment firms, mutual funds, and that kind of thing. So what they should have done is say, you know what, our products are pretty simple, pretty basic. We just need to shrink this industry, consolidate, get rid of, industry drops in life insurance is still important, but we're just not going to be competitive in these markets. That's what they should have done. That's not what they did. So there are too many life insurance companies in the industry because, all this money is going to investment firms that used to go to life insurance companies. All this money is going to banks that used to go to life insurance companies. So obviously there should be fewer companies. We've got too many companies. So what did they do? And this is really key here. They introduce complexity. And why do you introduce complexity? Well, if you're competing with people that you have a disadvantage, you make your product so complicated your customer doesn't realize your product's worse. And that's essentially what they did. They made their product so convoluted. And then they have a huge advantage. We'll talk about the huge advantage they have over banks and investment firms. But they're selling really, really complex. Remember, they went from selling really basic, simple products. Term insurance, you want $100,000 in term insurance, you go talk to 6 companies. It's real simple. You just take the cheapest one. Really, really simple. Whole life the same way. You want to buy a whole life policy, you just find one with the cheapest premium. Really, really simple. These products are just not like that at all. Very hard to know exactly what you're buying. And you have asymmetry of information. What I mean by that is the agent selling it understands the product much better than the person buying it. With term insurance, I need $100,000. Okay, we're going to charge you $30 a month. Well, this company charges me $25. I think I'll just go with them. There's not much debate. What else can they say? It's like, yeah, but our $30, we're really nice and we send really nice glossies to your house. I mean, who cares? $25 or $30. I'll buy the cheaper policy. That's what I'm buying. Life insurance is really simple. We're going to talk about when you introduce these new products, there's so many bells and whistles. Each one needs to be valued in some way. And there's no way any human person can look at all of those pieces and figure out if this product's better than this product. It's just not possible. And you combine that with the hard sell. How many commissioned sales reps does a bank have? Really none, right? That's not their business. How many commissioned sales reps do investment firms have? Well, they have wealth managers that get 12B1 fees, but essentially it's really not a commission-based business. Life insurance has a unique thing where its history is to sell things in someone's home, for tea and cookies, and you're sitting there talking to the person. Most people feel guilty if someone have just spent an hour with you and you say, I'm not interested. A lot of people they just feel obligated just because the person's been sitting there, especially elderly people. Elderly people get ripped off quite a bit because they just, they feel really guilty saying, hey, you spent an hour here and I don't want what you're selling me. So that combination of a tough salesperson, and you can kind of imagine, think how our egos work. Someone comes in and sells you this really complicated product, but they talk as if it's not complicated. And they go, you understand, see what I'm saying? What do you do? You go, oh yeah, I get it. And you're going like, I don't have a clue what the guy just said, but you feel stupid. Most people aren't going to say, I don't know what you're talking about. So you do all of that. And then at the very end, you say, yeah, obviously you're going to buy this product. You can see all the advantages I told you. And the person has no clue what they're buying. They don't understand it, but they just buy it because, that hard sell is there. All right. So that's real key part of it. I can't tell you the exact initiation of this. Was it one company that came up with this or what? So the first one we're going to see is Universal Life is the first one that shows up. And I don't know who was the first one to produce Universal Life, but once the first one produced it, it sold really rapidly. It was a very, very successful product. We're going to talk about universal life. I hate universal life. And I'll show you actual numbers why I hate it. It's a horrible product. From personal experience, I had some family members that had some, and it just was horrible. But that was the first one that was related to interest rates. And then when the stock market took off, they started selling variable products. We'll talk about variable products. I hate variable products as well. I'm not the only one that hates variable products. Y'all know Susie Orman? I mean, not personally. Oops. Yep. Have y'all heard of Susie Orman? I don't even know if she's still around. I guess she still is. Saturday Night Live, Kristen Wiig does a really good Susie Orman impersonation. She does Susie Orman better than Susie Orman does Susie Orman. It's really hilarious. You should watch it. Do SNL, Susie Orman, Kristen Wiig, and you'll know what I'm talking about. It's perfect. But she hates these things. Well, does Susie Orman hate annuities? Yes, she hates variable annuities. So she talks quite a bit about them. I don't know about Dave Ramsey. Probably similar. Is it Dave Ramsey or David Ramsey? So I'm not sure what his view is. My guess is he probably doesn't like them either. And we'll talk about when we talk about them why people don't like them. So you got variable in life, that's really complicated. You got universal life, that's really complicated. And now we have variable universal life, that's really complicated. But the industry said, you know what, that's not quite complicated enough. So now we're going to do equity linked life insurance, which is off the charts complicated. Albert Einstein could not figure that product out. All right, so you start off with complexity, you start off with the hard sell, and then you acknowledge the huge disadvantages that life insurers have. I just showed you underwriters, actuaries, you got a heavy investment arm. Those are expenses life insurers have that banks don't have, investment firms don't have. The life insurance operations, their business is much more expensive than banks and investment firms. I'm not saying your actuaries, overpaid. It's an important function, but it's an important function for what the life insurance does well, which is insure against premature death or living too long. This is not insurance. This is investing. When they get into the investment world, and get this in your notes somehow, when they get into the investment world, these higher expenses are a huge, huge disadvantage. In the insurance world, it works really well. Auto insurance, life insurance, actuaries do a great job. You have to have them, very, very important. But when you start expanding out in the investment world, those expenses are total, just dead weight. And then my least favorite is sales commissions. I believe sales commissions create conflicts of interest that are insurmountable. So, I mean, let's think about it. This one has a commission, $500. This one has a commission, $50. What does the company tell you? So the one most appropriate to the customer. You tell me, which are you going to sell? It's a really complicated product. It's almost impossible to understand. Product B is probably the better product, but with all these bells and whistles, there's probably a scenario where A is better. Which one are you going to sell? Which one do you want to sell? A, are you evil for that? I mean, you got to feed your kids, right? You got a family, you got a mortgage. That's what you're incentivized to do. I think it's insurmountable because of the complexity of the product. It was interesting at USAA, we had a product I hated and I kept fighting. I don't want to sell this thing. And my boss was like, no, we got to sell it. It's really it was a popular product. That's the reason when I sell it. I thought it's a popular product, but it's a horrible product. But we did it. And then, a few months later, my boss is like, why isn't anybody selling this? Why aren't we selling this? I go, well, we don't pay commissions. And our sales reps know it's a horrible product, so they're not selling it. You give them commission, they'll sell it. Without a commission, what are they thinking? This is a horrible product. I'm gonna get a horrible phone call 6 months from now when the customer figures that out. I'm not gonna sell this garbage. And so my boss is all mad. I was like, yeah, unless the only way you can get this, you gotta induce the salespeople to do it. And we don't induce, we don't pay commissions. They sell what makes sense because they don't want the horrible call coming back, a few months later. What about this one? Which one do you sell now? Is that a little tougher decision or is that a little easier decision? What is this? It's the equity link life. Yeah, these things have massive commissions. Now let's think about this. You go to a company and you give them $100,000. One product, they take $50 out and they invest the rest of your money. Or another product, they take $10,000 of your money out and they invest your $90,000. Which one product are you going to be better off 10 years from now? Is there any way that life insurance company is going to make you better off if they take $10,000 of your money off the top? It's just mathematically just not going to work out. And this product here is one that the person selling it probably doesn't understand it. He probably does understand this though. A 10% commission on a $100,000 premium. He can probably do that math. He may not be able to explain the rest of the product very well, but he'll understand that math. I hate sales commissions. I think it messes up. Now the Northwestern, I may have told you all this story, but the Northwestern sales rep who was trying to recruit UTSA students, she said, no, it's not a problem anymore because we now base our commissions based on our margins. And so that's even worse. Your commissions are based on how profitable the product is. I mean, that's horrible. And that's just terrible. Now, if every product paid a $500 commission, I say that's fine. And you induce your salespeople to sell, but they're going to sell the best product because they get the same commission no matter what. But that's not what they do. The insurance company pushes products. I mean, what the company does is they give high commissions on the products they make the most money on, and then they tell their sales rep, but do what's right, do what's ethical. And it's like, well, no, they're not, they have their own lives to take care of. And then the sales practices, obviously, they're going to give their salespeople good arguments for selling those worse products that are more profitable to the insurance company. So the training is going to be an issue. The sales practices themselves are going to be an issue. All right, this one is a huge one for me. We'll talk about this more when we talk about term versus whole life. But is it mathematically impossible to compare 3 or 4 of these complex products between each other and between companies? If 5 companies are selling an equity-linked life insurance policy, there's almost no way for you to tell which one's the best policy. And we'll see that. We're going to talk about equity-linked annuities in quite a bit of detail. The only way to compare these is you would have to set up a model and run maybe 1 million simulations and look at the output and see which had the better product. That's about the only way you could do it. You'd run, many simulations. I don't think there is any other, there's no other way, I don't think, because one product works really well in this environment, one works in this environment. You don't know what the probability of those different environments are. And it's not just the environment, but it's the path it takes. Did it go up first and then come down, or did it go down and then come back up? There's so many different scenarios. So you have to run it over several years with several different millions of different scenarios. What chance does an average retail investor have of understanding that? It's just beyond. But I'm going to show you the math on that. We already talked about asymmetries. I have that in twice, so it's not 2 different things. So you can strike that one out. I do question the asymmetries because while the sales rep does understand the product better, I don't think they fully understand it because some of these products really are so complex that people selling it really struggle with understanding them. Here's another thing I really hate. We're going to talk about this a little bit as well. It's the tax advantages. Life insurance is very tax favored. And so what the sales reps do is they really push that tax advantage when they sell the product and make a big deal out of it. And it's true. They're not lying. It's true. But then several years later, something blows up and there's a big tax problem. So the customer calls the company and says, I have this tax problem. And the company says, we don't give tax advice, consult your tax attorney. When I tell you the Danya story, that's the story she got. Or Miss Danya, 7-year-old widow, not that wealthy, and they told her to consult her tax attorney. Guess how many tax attorneys she has? She doesn't know what a tax attorney is. That's not her thing. So I'm going to argue if a product needs a tax attorney in the future, you should probably tell people that today. So don't buy this product unless you have a tax attorney. If their answer is going to be consult your tax attorney, they need to say that today. These products are incredibly complex in and of themselves, and complex when you put them against the US tax code. Very, very difficult products. The IRS gives advantages, but what the IRS giveth, it takes away twice as much. So these products are highly tax advantaged, but they're also extremely illiquid. They're hard to shut down and undo. You're somewhat stuck with them. So to get those tax advantages, you have to accept the fact that you're stuck with this product. Some products, like the variable products, the testing is showing you got to hold the product 25, 30 years before the tax advantage catches up with all those disadvantages. It's really, really tough. So the other thing we have to ask is, if you look at all that stuff together, how does it compare against the simple products? And that's what we're going to look at in an article. The article we're going to look at is going to say it outperforms the simple product about 4% of the time, underperforms about 96% of the time. When they outperform, they only slightly outperform. When they underperform, they underperform by a bunch. So you're better off with a simple product, overwhelmingly. That's what we call stochastic dominance. I don't know if y'all use that actuaries yet. Y'all done some stochastic classes maybe, but you run a million scenarios. Sometimes A works better, but overwhelmingly B works better. So it just dominates in all that modeling. So you might as well just go with B and ignore the fact that every once in a while you'll be better off with A. So next class, I'm going to tell you the tear jerking story. No, the class after next class we'll do what? The last articles, we're going to talk about them. All right. But I'll give you Danya's story. And we'll talk there. So any questions on anything? So get your paper 1 written for article 1 this weekend, get it out of the way, because it's all you really have to worry about right now. And read the other articles as well. All right, I'll leave it there.